What's going on, guys? Welcome back to another video. I hope you guys are all doing well. In today's video, we are going to be talking a lot more about continuations, starting from the basics first and then going all the way into more advanced talks and showing you guys some in-chart examples. So currently, I have a Miro board presentation pulled up for you guys. This is just focusing more on the basics. So for the people that are a little bit more advanced into trading, I would suggest to skip a little bit ahead into the video when I'm going over these in-chart examples. And you probably might find some things that you haven't learned before about continuations. But for the people that are new to continuations and that are just new to trading in general, I strongly recommend first you go ahead and watch my video that's posted on YouTube covering how to trade continuations. I'll leave it in the description below along with the free Discord as well. So if you would go ahead and check that out, you will be up to date and you will understand a lot more going into this video as well. So without further ado, let's go ahead and get right into this presentation. So most people, they really lose trading NASDAQ futures because they're either trading every single move, they're chasing breakouts, they revenge trade, and they have no framework. All right, if you've watched one of my previous videos talking about a discretionary framework, you would understand that a framework is necessary for all traders to follow initially, and then you expand and develop and add more confluences, add more trading styles to your framework that you've already developed. So me personally, the framework that I have developed and that I have started off with when I first started to learn how to trade was continuations. Okay, so we first need to understand, before we get into this framework, we need to understand how the market overall moves, right? We move in three common cycles, okay? Accumulation, manipulation, and distribution. Okay, with accumulation, we have to understand specifically that this is where the market moves sideways, right? There is not a good amount of volatility present. There is not a good amount of volume present. The market is just moving sideways. This is where orders are accumulating, okay? And then this is what we want to avoid. But we use this as a confluence in order to take a continuation trade when we get into more of the distribution phase, which is what I will explain a little bit later into this video. Okay, number two, we are going to be focusing on manipulation. All right, so this occurs after the accumulation phase has occurred already, right? So this happens after the accumulation phase has occurred, and then we manipulate in one direction. Okay, it can either be bullish or bearish depending on what the overall narrative is, what the overall higher time frame is looking like. Okay, so for those of you that are new to trading or just getting into trading, the higher time frame is going to be very, very important when it comes to us taking entries on the lower time frame. Therefore, manipulation is something that you want to overall get out of, right? We use manipulation in order for us to see if price action on the lower time frame is going to correspond with how the higher time frame is looking. All right, with manipulation as well, you do not want to be trading in manipulation, and manipulation usually occurs in the opposing direction, opposing intended direction. So if we are in a bullish market, if we see manipulation to the opposing side, we do not want to get faked out by this leg. Instead, we want to use this and see what happens in the distribution phase, right? So as we see here, this is an overall bullish example where we have accumulation here, we have manipulation to the opposing side, and we distribute to, the overall direction. So what can we infer from price action looking at it previously before the accumulation has occurred? Well, we can probably assume that the higher time frame has been moving in one bullish direction, and then we had this accumulation, we had the manipulation in the opposing direction, right, in the bearish direction, faking out traders, causing them to FOMO in, and unfortunately they get stopped because they put their stops at the high of the accumulation leg, which is over here, and then the real move occurs, and then now we get the distribution phase, right? So this is the real move that we want to be getting in, and this is how we catch our continuation entries, through this distribution phase, right? This distribution leg. All right, so now that we've covered all of these things, we now want to understand, what do real continuations look like, right? So we have a bullish continuation, and then we also have a bearish continuation. So this is happening after our distribution leg. So once we have prices shooting up or shooting lower, depending if you're trying to long or if you're trying to short, again, based off of the higher time frame structure, we want to see some sort of pullback in order for us to get our entry to continue higher or to continue lower, depending if we are in a bullish case scenario or if we are in a bearish case scenario, right? So this is what a bullish continuation looks like. So this would be through the distribution leg, right? Comparing this price action to here, we are clearly trending higher in one direction. Now, we want to see higher lows and higher highs. So as we can establish right here, we are probably, or not probably, but we are seeing higher lows and higher highs, okay? We see a low put in right here, and we see a high. We see a low put in here, we see a high, low, and then high, right? These are all higher lows and higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? So we've established the overall direction. Now we need to find our entry, okay? Our entry is going to be in the area that we pull back in, right? Now, what can we potentially pull back into? That is now the overall main question, okay? So these are supported by gaps or just by structure in general, okay? Usually when we get an entry, it will be within a 5-minute gap or a 15-minute gap. I will go over that more later, but once you see the structure, or at least this pattern form with an overall bullish trend, right, you would want to get in this overall area right here, right? This is how the structure looks. You would want to be getting your entry somewhere over here, expecting this higher low to hold, and for us to break past this high right here and create a higher high, right? Which is what we see occur right here, okay? So that is just a bullish continuation. So now we need to go ahead and look at more of a bearish continuation in order to see the opposing side, right? Now this example right here, we pull back into this 1-minute fair value gap right here. We see this pullback, and as we see, we're creating lower lows and we're creating lower highs, lower lows, lower highs, and lower lows, right? I'll mark it out here for you just in case. Lower lows, lower highs, and then we create lower lows, right? Same thing here. We have a low, and then we have a lower high, and then we also have a lower low. So this case, we are expecting the same thing as the bullish continuation, but instead it is just completely inverted, right? So we have a low, we pull back into this gap, and then boom, we see a move lower once again, okay? Now, in terms of your entries, this is not really as clear, right? Since we see price action isn't really giving us what we want in terms of a clear move lower. We see a good amount of chop over here as well, and then lots of chop here as well. But in terms of a structure, an overall bearish structure, this looks pretty nice, right? And you're able to make an example off of what a bearish continuation looks like. So we pull back into this gap right here. We see our impulse move lower, accumulate a little bit, and then we manipulate into this 1-minute gap right here, and then we get that distribution back lower as well, right? So going back to what I was talking about earlier in terms of accumulation, manipulation, and distribution, this happens on all time frames. This is one thing that you guys have to realize, okay? On the 1-minute, 5-minute, 15-minute, hourly, 4-hour, any time frame, we will see this phase occur, okay? But in terms of getting our entries, it is important to identify this on all time frames, all right? So as we see, we are distributing lower, and then we start to accumulate over here, and then where do we see the manipulation? Into this gap right here, and then we continue to distribute lower here as well, right? Now, in terms of getting our entries, I will go over that a little bit later once we get into these in-chart examples, all right? So another thing that we need to focus on that is very, very important, okay? We need to focus on liquidity, specifically draws on liquidity as well, all right? Price will overall move towards these draws on liquidity, right? Always, every single time, you will see price move towards points of liquidity, okay? But what is liquidity specifically? These are areas where traders place their stop losses, okay? So how the market moves is it moves and takes out stop orders, and it fills buy orders, right? And it also fills buy orders, and it takes out stop orders as well, okay, depending if people are long or short, all right, which is why you have your stop losses and you have your take profits. These are all areas of liquidity, right? So retail traders especially like to place their stops, again, looking back up at either these accumulation highs right here or these accumulation lows right here, okay? And it is very important that we do not trade in these areas of accumulation, in these areas of manipulation, or now we want to be trading in the areas of distribution where we put our stops at our lows, which is protected structure. I will go over that a little bit later into the video as well. And then we are going to be trying to, find a pullback in order to get our entry, putting our stop at protected lows or protected highs, and then we're targeting our overall drawn liquidities. All right. Now, going back to our examples, aka our drawn liquidities. What are the specific drawn liquidities that we are going to be targeting? We are going to be targeting swing highs and swing lows. We are going to be targeting session highs and session lows, such as London session highs and lows, Asia session highs and lows, previous day high, and then previous day low. These are all very strong drawn liquidities. Okay, and then we also have higher time frame unfilled fair value gaps. Okay, this is a 4-hour gap. This could be an hourly gap. This could be a daily gap. These are all prominent drawn liquidities to be targeting, right? And obviously, like I say, these become targets, and then we want to find the overall continuation trade in the distribution leg to these drawn liquidities, aka these targets. All right, so now since we have that established, let's go ahead and establish the continuation framework. Okay, number one, we want to be identifying our trend. This is not only on the higher time frame but on the lower time frame as well. Okay, we need to be focusing on time frame alignment. Now, what is time frame alignment specifically? So we start off with the daily time frame. Okay, the daily corresponds with the 4-hour. The 4-hour corresponds with the hourly. It corresponds with the 15-minute and the 5-minute and the 1-minute time frame. Now, what does this specifically mean? For every 4-hour candle close, or for every 4-hour candle close, we get a hourly close as well. We also get a 15-minute candle close and a 5-minute candle close and a 1-minute candle closure as well. Now, it is important that we focus on these time frames because when these new 4-hour candles open, or when these new hourly candles open, 15-minute candles open, 5-minute or 1-minute candles open, that overall aligns with us potentially taking an entry, right? So this is aligned with the higher time frame, and this is also aligned with the lower time frame as well, where eventually we are looking to take a trade off of the 1-minute time frame that correlates with all of these other time frames that I mentioned before, right? Now, number two, we want to be identifying our draw on liquidity, right? This is very, very important. Okay, our drawn liquidities we've already established. We have swing highs and lows, session highs and lows, and unfilled higher time frame for value gaps. Okay, now we wait for our pullback. So pullback is very, very important in order for us to take a trade. It can again be in the distribution phase of the leg where we pull back into these fair value gaps in order for us to take a trade. I'll also get a little bit more advanced and show you guys examples of trades that we don't necessarily need to pull back into either a higher time frame fair value gap or even a lower time frame fair value gap, and we're just solely trading based off of structure. Okay, that gets a little bit more complicated, but don't worry, we will overall cover that. All right, now step 4, obviously we just want to be entering, and then step 5, we want to be managing risk. How are we going to properly manage risk? We are going to be putting it at protected structure. Okay, structural highs or structural lows. Now, what does that look like? All right, these structural highs and lows are what are part of the overall pullback, right? So this is the pullback right here where we've pulled back into the gap, and then we have a structural high over here. So if you get an entry somewhere over here, your stop loss wants to be at this structural high, right? Same thing if you get an entry somewhere over here, let's say you have drawn liquidities lower, you want your stop loss to be at a structural high, which is over here. This is the point of invalidation, right? Now it's the same thing with a bullish continuation. If we look over here, it can be a little bit more clearer compared to the bearish continuation example that we have there, right? So we have a very prominent pullback right here. We put in a swing low. This is where our stop losses is going to be because it is at a structural low. It is at a pivot point, right? So once we see that move back higher, we can assume that price doesn't want to go back lower and sweep this low because this is parts of the higher low that we've created, right? and we're looking at this higher low to sponsor this higher high. And we've seen a history of price doing that before, right? We put in higher lows, higher highs, higher lows, and then higher highs, higher lows, and higher highs. Every time you put in a higher low in a bullish continuation, we have never went back and reverted to it and swept out the low, right? The structural point. So we're expecting price to do the same thing here as well, right? So now that we've established all of these things, we've managed risk, right? We've identified the overall trend. We've identified the drawn liquidity, waited for the pullback, and we got our entry over here. And then we managed our risk by putting our stops at these internal or at these structural lows and these structural highs. We can now focus more on the pullback, right? This is specifically where we are going to get our entry. All right. So obviously, this is what we are going to be looking for. We are going to be looking for a valid retracement, a valid structure that's forming, and then we need to be targeting strong drawn liquidities, right? Your pullbacks are not valid. Your retracements are not valid, right? Pullbacks, retracements, same essential thing. They have no meaning if you are not targeting a strong drawn liquidity, right? Like I've mentioned above right here, these are strong drawn liquidity points. So we should only be targeting these and only these, right? Nothing else, all right? Because those are the most prominent liquidity points in the market. All right, we need to be focusing on opens. We need to be focusing on session opens specifically, right? We need to be focusing on higher time frame candle opens. I'll also get into that a little bit later when we go more in depth talking about examples, but we need to be looking at specific session liquidity points, higher time frame gaps that are unfilled, and then just typical swing high and swing lows that are structurally created, right? Now, we want to be obviously correlating the higher time frame trend with the lower time frame trend. So if these two align, that means continuation will overall be likely, right? Now we get more into the specific entry logic, right? So this is again aligning with the pullback into valid structure right over here, and then we get the confirmation. All right, so we get rejections off of higher time frame gaps or lower time frame gaps, where price retraces into hourly gaps, 4-hour gaps, or daily gaps. That's all classified as a higher time frame. Or we get retracements into lower time frame gaps, such as 5-minute or 15-minute gaps, where we want to see not only a rejection, but we want to see displacement out of that area, right? So going back to the bullish continuation example, imagine this is a 5-minute or a 15-minute gap right here. We pull back into this area and then we get a move back up, right? So we get an impulse move back up, causing us to get our entry paired with some sort of entry model, such as inverse fair value gaps or just sheer displacement, and then we put our stop at the valid structure, right? And then maybe if we have drawn liquidities above right here, we can be targeting that, right? And as we see, we get a nice continuation higher, we get nice displacement and taking out our potential drawn liquidity higher, right? So that's what we should be overall targeting, and we should be looking for in terms of rejections off of higher time frame and lower time frame fair value gaps. We want to be pairing this with either inverse fair value gaps, or we want to be looking at just sheer displacement off of those areas, right? Now, number 2, we want to be looking for rejections off of highs and lows, right? So this is going to be specifically off of session highs or session lows, and this is going to be paired with a good amount of displacement, right? Some people call this a V-shape recovery. All right, V-shaped recoveries are very, very important because they show that there is strength in the market. Now, I will show that obviously later in the in-chart examples, but just to draw it here, just to show you guys, a V-shaped recovery will be looking like this. So let's say we have a bearish market that looks like this, right? Boom, we're going lower, and then we take out some lows right here. Let's say we take out lows to the left right here. Now, a V-shaped recovery is quite literally its definition. All right, that's quite literally what I said, where we instantly shoot up after taking out that low over here, and then boom, we get our entry back up to those highs, right? So we're sweeping out these highs, we're targeting these highs right here because we took out a low to the left, and it could be again a session low, or it could be a session high if we flip this, and then we're looking at a bullish case scenario. So as we see right here, we formed this nice V-shaped recovery, causing us to target the opposing direction, right? So can we get a continuation here? Yeah, boom. This could be overall aligning with the overall higher time frame. That could be bullish like this right here, and then we are looking for that V-shaped recovery. This could be paired with the inverse right here, and then we're overall targeting these highs that we put in, right? So with that being said, erasing all of this, we have the last thing, which is shifts in momentum. So sometimes we might not even reject off of higher time frame or lower time frame gaps. We might not be even taking lows or highs. This is very rare right here, I will say. This is rare, but we want to be adapting to market conditions, all right? Now, when we look at momentum shifts, usually we don't really get early entries. So we will be looking for, a good structure to be established. We want to be looking for a good amount of displacement, a good amount of volume that is injected into the market, and then we will eventually later be getting into the market at a later time. We're not going to be getting into it as early as rejections off of highs and lows, session highs and lows, or rejections off of higher time frame or lower time frame gaps. All right. So with this momentum shift, again, these are lower probability, but they're still valid if you're able to pair this with a very strong drawn liquidity, right? Like we've mentioned above. Okay. Now, we want to be talking about risk management, all right? And this is where most traders fail, okay? So good traders are able to maintain consistent risk, and the bad traders, they risk whatever they feel. They don't really care about not only where they're putting their stop losses and where they're putting their take profits, and when it's necessary to take your profits at a certain area, and where to have your stop losses, and why is it important that my stop loss is at that area, right? Paired with the fact that, again, they're risking all over the place. Sometimes they risk $200 on a trade, other times they risk $1,000 on the trade, right? Me personally, when I trade on 50K accounts, I am risking $500 per trade. Okay, on 150K accounts, which is what I usually trade, I'm risking anywhere between $1,000 to $1,500 per trade. So that leaves me with the 3 to 4 trade buffer in order for me to blow the account. All right, and with my trading style, in terms of trading continuations or just trading more discretionarily in general, I am able to not only be consistent, but I'm also able to get big wins here and there as well. All right, but again, focusing more on the framework, we want to be focusing more on base hits. We want to be focusing more on consistency. And then as we advance, we focus more on big wins and holding our trades to our draws on liquidity. All right, now this is very important to understand, right? Controlling your risk is what keeps you alive. All right, you want to be focusing on surviving till the next day. You don't want to be focusing on trading every single day. You don't want to be focusing on squeezing profit every single day, but instead you want to be understanding, okay, if I don't take a trade today, did I survive till the next day? Yes. And if that is so, you are good. You don't need to worry about anything else, right? Our whole goal as traders is to trade to be able to survive till the next day, and the day after that, and the day after that, and the day after that. We do not care about securing profit. We do not care about making as much money as possible. We care about surviving, all right? And risk management is very, very key in order for us to survive, all right? So now that we've established all of this, let's get into trade management, okay? For beginner traders, we want to be going for base hits. When I first started, I was also going for base hits in terms of me not targeting a large amount of RR. I was just targeting internal highs or internal lows. I wasn't really targeting these higher time frame drawn liquidities, but instead I was just trying to get in and get out, right? Because I wanted to build my confidence levels. Now, when you get more advanced, you want to be getting more out of your comfort zone. All right. So once you've understood that you've learned, the model, you've learned a framework, you've learned how to essentially trade, and you understand more of market structure, you want to be holding to where you believe price is going to go, right? Again, based off of the drawn liquidities that we've talked about, this is where you want to be holding towards, all right? Now, you move from more of a fixed RR to more of a larger risk to reward, and then you're also, as a result, getting larger payouts, and then you're taking fewer trades, right? So this is very important to understand, because when you are targeting higher time frame draws on liquidity, your RR is not fixed, right? Your risk to reward is not fixed. Sometimes it could be a 1-to-1, sometimes it could be a 1-to-2, and then on days where the market's really trending, it could be a 1-to-4 or a 1-to-5, all right? We are now trying to adapt more to market conditions, and as a result, sometimes we make more money, other times we make even more money. Sometimes we just lose more money, or sometimes we lose less money. But overall, what doesn't change between these two things is that our risk will be always consistent. All right, we are always going to be risking relatively the same amount, and then we are going to be sizing up as we get bigger accounts, right? Or when we get more profit, right? When we build more of a buffer on our accounts. All right, cool. We've established this. Now let's go and talk about discretion. So why does discretion overall matter in the markets? Okay, I strongly believe, and then a lot of other profitable traders will probably agree with me as well, you cannot trade mechanically. Retail traders cannot trade purely mechanically. Why is this so? If retail traders, if there was some sort of mechanical strategy that worked X amount of the time, right, 60, 70, 80% of the time, every single retail trader would be rich. Okay, now we want to start off with the mechanical framework, but then we want to apply our own discretion on top of that. Now, what is discretion? Discretion is the ability to understand when to take current setups and when to avoid current setups, right, that are forming in the market. All right, and this overall is your edge. Discretion is overall your edge. Over time, you are going to be able to develop it through experience, just by looking and showing up to the markets every single day, by journaling efficiently right here, and then by collecting data. All right, you're journaling, you're reflecting on your trades, and then you're understanding that each trade that you take is just another point in your data set. All right, so this is overall how traders refine entries over time, right? Through discretion, through gaining market experience, through journaling, and then through just overall collecting data, right? Now, when we go to this part right here, this is the biggest trade. This is the biggest mistake that I see traders make. They skip this overall framework, right? They don't build any sort of routine. They don't have any sort of consistent habits that they do on a daily basis, such as, again, journaling, collecting data, reflecting on their trades. They don't do any of these things, but instead they just go ahead, they try to copy their strategies, they take signals, they trade randomly, and there's no absolute structure, right? So no structure equates to no consistency. Now, what is the overall goal of trading? This is what you have to ask yourself. The goal for you, the goal for people is ultimately different. But one main thing that we should all consider and all remember is that the goal is not to take a trade every single day, and the goal is not to chase dopamine. You are never going to progress in this field if you are focusing on these two things, right? The ultimate goal is to always execute high probability trades consistently. And when you're able to do this properly, trading overall becomes very, very simple. All right. And obviously, if you want to join the free Discord, I'll put the link in the description below. But with that being said, let's go ahead and get into these in chart examples finally, so we can make this visually make sense, right? And put all these words into actual pictures. All right, so I'll see you guys when we are breaking down the trades that you could have taken this week, and the trades that I personally have taken this week as well. All right, so now we made our way onto the charts, but before we get into the examples of this week, I want to focus on the 3 specific types of continuation entries and focus more on the key opens as well. So we are going to be getting a little bit more advanced into continuations here, and I will show you guys obviously the in-chart examples in a little bit, but let's go over this really quick, right? So we've established, going over the presentation, that we covered accumulation, manipulation, and distribution, and that we should be entering in the distribution leg, right? So whenever we have distribution, we can either get our pullback immediately once we see displacement in the distribution leg, or we can get a continuation when we get a retracement into a lower time frame fair value gap, right, that aligns up with the distribution leg. So these two things are basically almost the same. It is just when we overall get our entry. Is it right after the accumulation and manipulation phase ends, and then we get that distribution back in the same direction, or B, we still get the accumulation and manipulation and we get the same distribution, but we get this is paired with a retracement into a lower time frame gap, such as a 5-minute gap, 15-minute gap, or even a 1-minute fair value gap, right? And then we overall get that pullback, and then we get that displacement, we get that inverse fair value gap, whatever it may be, we get our overall entry paired with the accumulation, manipulation, and distribution cycle. Number 3, we get continuation based off of momentum and volume, and we're just purely focused on our drawn liquidities. So we don't need to have a retracement into a lower time frame or higher time frame gap. Sometimes we may edge it, and then we will have momentum, we will have displacement that is just overall trumping the retracement into our higher time frame or lower time frame gaps. Now, when this occurs, this is a lot more discretionary. This is a very discretionary, right? And we might not see this happen often, but if we're able to adapt to market conditions, and if we're able to understand that our drawn liquidity is very prominent and it is very important, we potentially are able to get a continuation entry based off of this. All right, now number 3 is also paired with number 1. So all 3 of these things, actually I should say 2 of these things, have to do with number 1, right? Without accumulation, manipulation, and distribution, you usually do not find your entry in at all, right? Because the market runs on accumulation, manipulation, and distribution. All right, so now that we covered that, let's go over these key opens. So any session open is very, very important. So it can be New York AM session, it can be New York PM session, it can be London session, Asia session, and also new day open. Now, new day open is only realistically very, very important. Also, I forgot to add, we have midnight open as well, right? So these are key opens. I have indicators for that as well. I'll go over that in a little bit, but to actually track these session opens. But new day open is really only important when we see the new day candle. So the daily candle opens with no wick on one side. All right, same thing with the 4-hour candle. That's for another video. I won't get too in depth into that, but I at least first want to go over overall and cover the new day opening candle, and just show you guys really quick why it's super, super important. So if you just look at basic candle anatomy, right, you want to see wicks form on both sides of the candle, right? A wick higher and then a wick lower. All right, and just basic candle anatomy also says that it should form either in an open high, right? The candlestick should either open higher and then we close lower, right? If we want to have a bearish candle, this is a bearish candle sequence, or we either open lower and then we close higher, that is forming a bullish candle sequence, right? With that being said, if we ever have a daily candle that opens with no wick on one side, we want to see this happen essentially, right? Where we're targeting the opposing side, we're targeting this open, which is called a devil's mark, where we put a wick on the opposing side. It's the same thing in a, on the other side as well, where we open lower and we're trying to, see a wick on the other side, right? So that means we open completely bearish. We want to see this overall candle flip and then close higher on the daily candle, and then this is all like lower time frame price action, on the 5-minute or 15-minute price action, right, where we can get an entry on our lower time frame to correspond with the higher time frame and us putting a wick on the opposing side, right? So now that we've established that, that's why new day open is very, very important. Now midnight open, that is that is obviously the new day, right? There's a new day open that occurs at 6 p.m. Eastern when we open the new session and the new daily candle, and then we have midnight open is when we actually overall transition to the next day, right? So we tend to see price react off of this midnight opening price. So this is also very, very ideal to understand, right? This is crucial to understand that price is going to potentially react off of midnight open. All right, just by collecting data, you will see that price, and just observing it in the live markets, you will see that price reacts off of midnight open. All right, now last thing is 10 a.m. open. This is very, very important to understand. Okay, so 10 a.m. open marks the new 4-hour candle open as well, and this is where price starts to be very, very manipulative. All right, so we factor this in with overall higher time frame price action and lower time frame price action as well, and we can kind of understand where this 4-hour candle is going to end up going. Again, paired with higher time frame draws and liquidity that we've talked about, session highs, session lows, swing highs, swing lows, higher time frame unfilled fair value gaps, right? We are able to now align this with our 10 a.m. opening candle, opening price and the 4-hour candle where it wants to specifically go based off of previous structure. All right, so now that we've established this, we can overall go and get right into the first example. All right, now on Monday we had we went over example 1. If I can go back to it right here, right? Continuation after AMD, and we're entering right in the distribution leg. So over here specifically, we got a very, very early entry right here. If you entered mid candle, you were able to, enter right here, which is also nice to get, right? If you're able to get mid candle entries just by observing that price is already done with the accumulation phase, manipulation phase, and distribution phase, then you are able to get that nice little mid candle entry just based off of understanding that. Now, SMT, we have a SMT with ES at this specific moment, and this is also paired with the accumulation, manipulation, and distribution phases. Basically, that happened simultaneously, right next to each other. So where is the accumulation phase? Right here. This overall is our accumulation phase, right? All of this price action, this is pre-market. We see prices just zigzagging up and down, right? Obviously, we do not want to be participating in this price action since this is pre-market, but this is a good thing because this sets us up for the manipulation that happens at 9:30 open, and then for us to distribute back lower, right? Targeting these accumulation lows. So this looks a lot more clear on the 5-minute time frame where price is very, very bunched up right here, right? So as we see, we accumulate, and then 9:30 at this area right here manipulates past these pre-market highs. We also put in an SMT with ES, which is a added confluence, and then we get that distribution back lower to these accumulation lows. All right, going back to the 1-minute time frame to get your specific entry, if I can just overall go back here, getting our specific entry, there are multiple things that we can overall look to enter off of, right? So obviously we have the classic inverse right here where we end up, getting our bullish for value gap that forms, boom, right here. And then if we just go into market replay, just breaking down price action from 9:30 open, right? As we see, this is the open of New York session. So we're looking at this to manipulate past these highs right here. So we not only manipulate past these highs, but we also put in a SMT with ES, right? So this is very, very open. And then this is obviously 9:30 opening price right here as well, right? So I'll mark this out, 9:30 open. This is key, right, to see if we also respect open or if we do not respect open. That is also a key area to see if we do want to go lower, right? So we have the accumulation, we have the manipulation. Now where do we have the distribution? All right, this is where we now reject off of this SMT, putting in this bearish candle right here. We go lower. We're now respecting this gap initially, this fair value gap initially, but we put in this retrace leg right here, right? We have these two retracement candles right here, and then boom, we get a nice sharp bearish candle inverting this gap right here. Now, if you are more advanced, you are able to get a mid candle entry off of this displacement candle right here. Why? Because you've established that we've already accumulated pre-market, we've already manipulated off of 9:30 open, taking out these highs and putting in an SMT, which is not needed, but it is an extra added bonus confluence. And then we see price reject off of this SMT, off of taking those highs. We have these accumulation lows as our strong draw on liquidity, and then we go lower initially. We fail to inverse this gap right off the bat. We put in this retrace here, and then boom, we get a displacement candle. Now with your mid candle entries, you want to be focusing also not only mid candle entries, but just any entry, even if you get it right here, right? You want to be putting your stop at a protected area. Where is the protected area in this scenario, you may ask? It is at the swing high, right? This is the extreme point of invalidation because, again, 9:30 manipulated past these highs. We already took out these highs right here, right? This high right here. We put in an SMT. So after seeing this displacement, if price wants to go back higher and take out this high, this trade is now invalidated because it is a swing high. It is a structural high that should not be broken, right? If we want to continue lower, okay? So it's either you get your mid candle entry here and then you get a nice 1 to 2 RR, putting your stop at the structural highs, or you wait for the inverse fair value gap that happens right here. You enter right here, and then you can put your stop at the bodies, to get to 1 to 1 RR. If you put your stop at the ultimate high, right? You don't get that 1-to-1. So you can be a little bit cheeky with it and then put your stop at the bodies, because ideally price shouldn't even go above this area right here. Why? Because this is the retrace leg that has occurred before putting in this point of invalidation, right? We invalidate this retrace with this bearish candle right here, causing our inverse. So realistically, price should not go above this general area at all, right? So this is our protected structural stop. And then now we play out price action and we see we go and overall take this low, right? Now, in terms of your break even point, you can go break even at this low right here. You can go break even, you know, at these equal lows right here. You can go break even at this little low right here as well. Or you can just let the trade play out because you realize that it is just a 1-to-1 RR, and you might as well, you know, let the probabilities play out, right? With the 1-to-1 RR, realistically, your win rate should be anywhere between a 65 to a 70%, because your stop loss is the same amount as your take profit, or at least near, right? Which increases the probabilities because you're giving room more time to breathe, or sorry, you're giving price more room to breathe, right? Essentially speaking. So that was the first trade. Again, this is a clear textbook example of accumulation, manipulation, and distribution, where we have the accumulation over here, the manipulation occurring that's lining up with 9:30 open, right? New York AM session opening, and then we have the distribution phase, which is our entry, right? So this is more of getting your continuation entry earlier, right? Just based off of very minimal structure on the 1 minute time frame, but overall corresponds with structure that we've been seeing pre-market and these structural highs that we end up not only sweeping but putting in SMT with. All right, so that is the first example that I wanted to show. Now let's go ahead and get into the second example. All right, so now we are looking at example 2 over here. This is Tuesday of this week, Tuesday, March 10th. So let's break it down in terms of looking initially at the higher time frame and then also looking at the lower time frame to get this entry right here. So this overall falls with example 3, where we're not retracing into any higher time frame gaps initially for us, you know, to set a condition for a price to have this big impulse move here, right? This impulse move here right off the bat occurred just basically out of thin air, right? But it doesn't mean we can't get an entry, because overall, right, since we're entering all the way over here, we've established that price does not want to retrace into a higher time frame gap. So let me show you what higher time frame gap specifically I was talking about. So for this, we need to be going all the way to 9 a.m. And we need to be looking at the higher time frame right here. So if we look at the hourly time frame, we have multiple things to take care of. All right, number one, looking at the overall higher time frame, this bullish leg, we fill in this new week opening gap in price right here. We move higher as well, and it looks like we take out some points of liquidity right here, right? So once we fill this gap right here, we also take out these highs right here as well. As we see, we take out these highs. It looks like we want to see some sort of potential retracement, right? Again, what we want to be looking for after we take out external draws on liquidity is a retracement back into internal draws on liquidity. Now, what are internal draws on liquidity? Retracements into fair value gaps, higher time frame fair value gaps. Once we take out external structure, we want to see retracements into internal structure. What is the internal structure that we have right here? Okay, we have this low that aligns with this 4-hour gap right here, right? We want to see price overall retrace into this 4-hour gap. Not only that, but this 4-hour gap also lines up on the 15-minute time frame. If we see, it lines up with Asia low. And what did we say about Asia low, Asia high, London lower, London high? These are very prominent draws on liquidities, right? Session highs and session lows, and also unfilled higher time frame gaps. Now, once we see both of these things stacked together, that is just an ultimate very strong draw on liquidity. All right, so we want to be targeting this. After we take out external liquidity, we see structure is overall forming bearish, and this looks like a very clear draw on liquidity for us to target if a market open wants to go lower and dump to this area, right? One thing we also have to notice is that price action is a little bit wonky over here. We're not moving efficiently, but after we take out this high, we are now displacing in one direction, right? So we can view it one of two ways. If we get, number one, if we get a continuation entry to Asia low / this unfilled higher time frame fair value gap, we would very well like to take it. Or B, we can use this as a condition to us tapping into this area, and then we get some sort of displacement and us pushing back higher to target London high, which is again a very strong draw on liquidity, and this overall aligns with the higher time frame trend that we've seen right here. Right now, what we need to do is go to market open and see what we end up doing. So playing out price action right here, what do we specifically see? All right, we see price is just not really doing that much right off the bat. We end up consolidating, which isn't really that ideal, right? But this accumulation right here could set up for some sort of manipulation into this gap right here, and then we can get the distribution back to this area right here. So again, like I said, accumulation, manipulation, and distribution. Not all accumulation is bad. You just have to let it play out and then wait for the manipulation and then wait for the distribution to get your entry. All right, playing out more price action right here. We see prices just overall stalling. We end up chopping lower and lower and lower. Now, this is where things go a little bit south. All right, we do not end up tapping into this higher time frame for value gap in order to, confirm the manipulation. But what we do end up doing is that with ES at this specific moment, we put in a SMT with the swing low right here, an external SMT, which causes us to move higher initially, right? Now, off of this, we are seeing momentum. We are starting to see some sort of volume in the area of intent, right, which is London high. And ideally, we would like to see us retrace into this higher time frame gap. But again, adapting to market conditions, we essentially don't need to retrace into this gap, right? Is it improbable for us not to retrace into this gap, especially after the external draws that we've taken out? Yes, it is. But again, if you're able to adapt, you're still able to overall get an entry, right? Now, again, like I said, this is rare. I've said this earlier when I was going over the presentation. This is rare to see, but it doesn't mean, it is a no trade day. You can potentially still take a trade. You just have to be patient, all right? Playing out more price action, what do we end up seeing? We're starting to invalidate bearish structure right here. Okay, we invalidate this bearish gap. We're pushing higher. Again, this could just form as some sort of manipulation higher for us to go back lower and tap into this higher time frame gap right here, right? Which is why, again, we want to stay patient. We potentially do not want to be getting any entries over here, even though it looks like on the 1 minute time frame or the 5 minute time frame that we may be displacing, right? Until we have invalidated a good amount of structure, then we are able to potentially take our entry. Okay, first sign of us respecting bullish structure is right here off of this 1 minute gap right here. We don't disrespect it, we don't invert it, we just react off of it and push higher, right? Same thing over here. We also have this 1 minute gap right here that we respect, boom, and then we push higher off of that, right? So we're continuing to do that. We are creating bullish structure. Now at this point right here, it is now safe for us to potentially take a trade to London high, which is a strong draw on liquidity, right? Could you have potentially taken trades right here as well? Yes. We respect this 1 minute gap. We push up higher. Okay, maybe you don't take a trade off of this, but we respect this 1 minute gap right here, and then maybe you get a mid candle entry since, again, you've established that we are displacing in this current direction. We have a very strong draw on liquidity, which is London high, and then potentially you can get an entry, off of this candle closure right here. Boom, you have your stop at the lows, and then you're overall just targeting London high right here. Maybe you're going break even at New York AM session high, and then you're just letting the trade play out for a nice 1 to 2.5 RR, right? So this is a potential entry, and then now we have this entry right here where price has overall broken out of this range right here, and then now we're looking for some sort of mini continuation to this high right here, right? So now this is lining up also with the second type of continuation entry, which is a retracement into a lower time frame gap. So again, we have established that price is showing shallow retraces, so we're expecting this to hold as well as a shallow retrace. What is the shallow retrace that we are seeing? We see this 3 minute fair value gap right here that opens up, right? If I actually make this a little bit better, we have this 3 minute fair value gap that opens up. As soon as we tap into it and we get some sort of displacement higher, that is our entry trigger. So playing out price action here, boom, we get that displacement entry over here, and then you can just hold it to London high right here, and then you can put your stops at the area of invalidation. You can either put it here, or if you're not that confident in this low, you can put it below the 3 minute gap right here, right? Because realistically, price should just respect this area, and then go back up, because that is what we've been doing overall, looking at this leg higher, right? Again, these are more rare entries because ideally you would like to see price retrace into a higher time frame gap before creating the distribution leg, right? So we have the accumulation here, the manipulation occurs at this SMT, and then we get the distribution back higher, right? Now playing out price action, what do? We end up taking out our drawn liquidity, our strong drawn liquidity, which is London high. All right, so that was example number 2 that you could have taken for the week, or for the day Tuesday of this week. All right, now let's go into our third example. All right, going on to example number 3, we are now on Wednesday, March 11th, and this was the day of CPI. All right, so we need to establish a few things first on the higher time frame before we get into this entry right here. So if we look at the 15-minute time frame right here, we overall see that we are in ranging price action, right? From this low to this high, we have been accumulating in one direction, right? Or not in one direction, but again, we've been accumulating sideways. We've been moving sideways. All right, so in terms of our targets, we probably don't want to be targeting these extreme highs right here, but instead we want to be targeting internal highs, right? So this right here, Asia high, is not only a strong draw on liquidity because it is a session high, but it is also a nice structural swing high, right? So we see a little mountain peak right here. That is the formation that shows us that it is a swing high, right? Another mountain peak formation right here, a nice swing high. But the reason why we're targeting this and not this is because this is the external range high. We can easily go up and take out Asia and reject back lower, which is why we want to be careful when we are in range-based conditions. Now, just because we are in range-based conditions on the higher time frame, it doesn't mean that it is a no trade day. We can potentially still see an entry on the lower time frame when it comes to us retracing into 5-minute gaps, 15-minute gaps, or us just taking out liquidity in opposing direction and getting a V-shaped recovery. So with that being said, we can now go into market open and see the potential entries that we are getting. All right, off of this 930 open right here, we have data high. Okay, so data high is a very, very strong draw on liquidity. This aligns with the CPI CPI candle. This is one thing that I forgot to mention as well. Another strong draw on liquidity are data highs and data lows. Okay, so these form with red folder candles. Essentially, whenever you see them, you want to be ideally targeting them if we are trending in that direction. This is pre-market, so obviously you're not going to be taking a trade to these data highs, but we can see what 930 does right off the bat with data high right here. Okay, we go pump up, we manipulate past data high, and then we look like we want to go and take out Asia high right off the bat, but we end up forming structure first before we end up taking out data high, right? So we start to accumulate right here, right? So we manipulate, and then we have accumulation right here, and then now we want to retrace into a fair value gap, right? What is that overall fair value gap that we retrace into? So we have this 15-minute gap right here, or I think we retrace into a 5-minute, something of those sorts. Yes, we retrace into this 15-minute gap right here that I marked out. So if we look at the 15-minute time frame, what do we end up seeing? We are in this 15-minute gap, we took out data high, and then we have this structural range high, which is also Asia high, a strong draw on liquidity. So what are we expecting? A reaction out of this 15-minute gap for us to push and take out data high, right? This is exactly what we get. Not only a push up higher, but we get a nice V-shaped recovery as well. So we tap into the midpoint of the 15-minute gap. Essentially what the midpoint is just the 50% mark of a fair value gap, right? These are very important because this allows us to have the most efficient stop loss, right? If we tap into the equilibrium of a higher time frame gap or of a 5-minute or a 15-minute or even a 1-minute gap, essentially price should not go back and revert if we get our confirmation off of the midpoints of gaps, off of equilibriums of gaps. What do we see right here? We see a nice V-shaped recovery causing our inverse fair value gap at this area right here. I will overall just remove this 15-minute gap retrace, but we get this inverse fair value gap right here. We can put our stops at the protected low, right? This is our pullback, and then now we are getting our confirmation with this inverse, and then we are going to be targeting the Asia session high, right? What do we end up doing? Boom, we end up going up and just taking this area out, right? We take out this drawn liquidity, right? So this nets you a nice almost 1 to 3 RR. And if you're just able to identify pre-market structure, and if you're able to correspond that with New York Open and identify what strong drawn liquidities there are, your entries get a lot simpler, right? So this is the textbook continuation entry off of 5-minute, off of 15-minute gaps. In this case, it was a 15-minute gap that aligned with the 5-minute gap, but realistically, you should be looking at the higher time frame, always the highest time frame gaps. So we retrace into this 15-minute gap, which is the highest time frame gap, and then we get that nice V-shaped recovery. Overall, just continuing the trend that we see in this ranging market, right? So that was example number 3, very straightforward. Just to play out more price action, what do we end up doing? We end up retracing back into this range, and then we don't take out this high right here, right? It is very important that we understand that in range-based conditions, not to target the extreme highs or the extreme lows when we are pretty much, a good amount away from that area, right? In this case, from our entry, we were a good 170 points away, which is pretty far, which is why you want to be targeting the nearest strong liquidities. And regardless, this nets you almost a 1 to 3 RR regardless, right? So you should be content with that anyway, right? Targeting 81 points, risking around 30 points. That is example number 3. Now let's go into Thursday, the final day, where we had multiple examples that I do want to show you. Okay, so now we are specifically looking at Thursday's price action. So this is Thursday, March 12th, and before we get into our entry, we have to look at the higher time frame once again, right? So, or the mid time frame in this case, because it is a lot more clearer than looking at the hourly or the 4-hour in this case, because you guys can distinguish what is going on a lot more clear. So we see that we have this accumulation, right? On a larger scale, we have accumulation, we're moving sideways. Where do we see the manipulation? Right? The manipulation occurs, or the breakout first is what happens, right? We break out of this accumulation right here, and then we retrace into the 4-hour gap. Remember with the previous example that I was talking about, I think, on Tuesday, where we were initially trying to target this 4-hour unfilled, we did not do that, and we finally ended up accumulating, and then we finally broke out and filled the 4-hour unfilled gap right here, right? With that being said, what do we see? We see a manipulation back into this area, and then now we are trying to see a distribution back lower into Asia low, right? Accumulation right here, and then we see a breakout of the accumulation. We see a manipulation back into the range, distribution back lower, right? Where do we manipulate back into after breaking out of this range and then filling this unfilled 4-hour gap right here? That is a good question. If you look at the 4-hour time frame, we end up manipulating into this 4-hour gap right here. Now, it may look like we have inverted this gap, but ideally, we are not going to be taking an entry off of this, right? Because this is the 4-hour time frame. So this inverse doesn't really hold much power if the next candle is overall opening bearish, and this is aligned with the accumulation that we've seen right here. We see the breakout of the accumulation, and then we manipulate back higher instantly, right? This manipulation causing this 4-hour inverse is used to fake traders out, thinking that we are going to go back higher to these recently taken out highs right here, right? Taken out draws on liquidity, okay? But as we see with this next 4-hour candle, we are distributing lower, and then this is where we are going to get our continuation entry based off of this distribution leg, right? But obviously we need to see this on a lower scale, not on, we need to see this on a smaller scale rather than a larger scale on the higher time frame. So this is where we go into market open. We obviously are doing our analysis where we see a manipulation into this 4-hour gap. We now see that London on a smaller scale is accumulating, right? So we want to see price break out of this accumulation, and we want to see a distribution back to London low and Asia low, which are very strong draws on liquidity. Okay, so in this day, there are multiple examples as we see that we have drawn out right here. Okay, let's go ahead and get into both. So right off of market open, what we see clearly that oh, why are we on XAU USD? Why are we on gold? All right, anyways, back to what I was saying. Playing out price action right here, what do we do initially? We manipulate higher, right? We go out, we take out London low, and then we get a manipulation into what? We see a 5-minute gap right here, okay? So we take out a strong draw on liquidity, which is London low, but overall we have a stronger draw on liquidity as well. That is not only a swing low, but we have Asia low, and this aligns with overall structure lower once we've seen that we've manipulated into the 4-hour gap, and we're expecting price to distribute lower, right? Accumulation, manipulation, and distribution on that larger scale. We have identified that. Now we want to identify this on a smaller scale. Over here, we are accumulating in this little zone. We are manipulating into this 5-minute gap, as we see right here, and we're expecting this to cause the distribution back lower to Asia low, right? This is where we get our entry. Right now, we go to the 1-minute time frame to get into a larger scale, right? We get that manipulation, and then we stall for a little bit around the 5-minute gap, right? This accumulation is good because it sets up for us to distribute back lower to Asia low, which is our strong drawn liquidity, right? So as soon as we see this displacing candle from this accumulation period right here, we can now put our stops at the protected high that tapped into the 5-minute gap. We see this displacing candle, we get our entry, and we're expecting price to distribute back to this to Asia low, right, which is our strong drawn liquidity. What do we end up doing? We can go break even at this low right here. Perfect. And then after we take out Asia low, what do? We go back higher, right? And then we go back lower off of that. No entries over here that formed. Now, what do we see at this area? Okay, we are 3 minutes away. We are 3 minutes away from opening a new 4-hour candle, right? So like I was saying earlier in the presentation, this is very important to note, because if we manipulate higher off of 10 a.m. open, we are looking at this 4-hour candle to close lower. Why? Because look at overall price action. We are moving lower. If you look at the 4-hour time frame as well, it will be a lot more apparent that we want to see this next 4-hour candle open bullish and close bearish. Why? Because we have lower targets. We want to rebalance this overall leg, because we've taken out a bunch of draws in liquidity higher, and then now we've had this accumulation, we've broken out of the higher time frame accumulation, and now we want to rebalance this overall range. So this is where we take out our fib tool, we mark it from the low to the high right here, and then we see that we are very, very close to the equilibrium of this overall leg. Now we align this with the 10 a.m. open, where if we see the new 4-hour candle open bullish, we are now expecting to potentially find an entry to the equilibrium of this range right here, of this leg, right? Playing out price action, we see immediately that the 10 a.m. open manipulates higher, right? We push higher. We have a drastic push higher as well to area of interest. This is our 10 a.m. open. So this is also very, very important to note, right? 10 a.m. open. Very, very important to note. I'm going to put this to the right here. And then we need to see where we are manipulating into. All right. Looking at the 5-minute time frame, I think 15-minute as well, we see that we open higher, right? With this 15-minute candle, we open higher. Also, the 4-hour candle as well, you probably can't see it. Actually, you can. You see with this 4-hour candle, we are opening higher. So we're expecting this to be the highest wick and then pushing us lower to finally tap into the equilibrium of this range. All right, playing out more price action. Again, note that we have 10 a.m. open right here. So I want you to see what price ends up doing in this area, right? 15-minute time frame, do we still have anything? Okay, no. 5-minute time frame, do we have anything? Also, no, right? So we go back lower. Look at what we do. We tap into the 10 a.m. open. We respect it, and then we manipulate higher after this, okay? This is where we get our entry. Where is our entry? This pairs with the 5-minute gap right here, okay? We've seen us manipulate higher with the 10 a.m. opening candle, right? We push higher, we put in this higher 4-hour wick, and then now we get instant displacement lower, okay? We are now aligning this with the overall 4-hour candle, where we want to see this, since again, we've made this open high, we've put in this wick higher, we want to see this flip bearish and then tap into this area. Not only the 50% mark of this range, but this overall 4-hour unfilled gap, right? So this is a very strong drawn liquidity as well. All right, we've established that. We've seen us manipulate on the lower time frame as well into this 5-minute gap, and then we get an instant flip lower, right? So this is where personally I got my entry off of the wick here. I was entering expecting price to distribute lower after we've manipulated into the 5-minute. So this is more of an advanced entry. This is where I got my entry in today's market, because at the time of recording it is the 12th on Thursday. So this is where I got my overall entry, and then I was just targeting this internal low because I did not want to be too greedy, right? So I had my stops at the highs as well, and then I was able to secure a nice 1 to 5 RR. But for people that were waiting for more confirmation, you were able to get an entry here as well. You saw we reject, we see a sharp displacement lower as well with the next candle, and then you could be targeting here, or you could be targeting the equilibrium of the range as well for a nice 1 to 2 RR. Playing out price action, what do we see? Price just overall delivers smooth as butter, right? That was the last example for the video. So yeah, that's basically it for the video. I hope you guys were able to learn something from this. Again, if you're not in the free Discord, go ahead and join. I'll leave it in the description below. But I hope you guys enjoyed this informative video, informative style of video. If you guys have any questions, leave it in the comment section below. And with that being said, hope you guys have a great rest of your day, and then I will see you guys in the next video. All right, peace.